Welcome back to the Investing on the Go podcast brought to you by FundCalibre. We're focusing on renewable energy infrastructure this week and the impact of rising interest rates on the broader investment trust sector.
Hi, I'm Josh Murphy. Today, I've been joined by Will Argent, investment advisor of the Gravis Clean Energy Income Fund. Hi, Will. How are you?
Hi there. Very well, thanks. Thank you for having me.
Well, great to have you on. Let's kick things off. The fund sits in the IA infrastructure sector. How does it differ from a typical infrastructure fund?
Well, I think firstly, the clear thematic focus of the strategy, which is on infrastructure relating to the energy transition. So the underlying portfolio has a very large core exposure to renewable energy generation assets. So that's a clear differentiator against sort of broader infrastructure strategies. I'd also suggest the sort of keen focus on income generation that we have. I'm not so sure that is a key area of focus for other strategies, but it is for us. We're an income focused vehicle, and we are targeting 4.5% net yield.
And Will, this fund invests in investment trusts within the sector. As rates rose, a lot of investment trusts suffered. Do you think we'll see a strong bounce back when we get more clarity on rate cuts?
Yeah, so I think just to provide some context around the sort of recent situation, these renewable energy companies, these renewable energy infrastructure assets provide exposure to very long-dated cash flows. Now, as interest rates increased and as a result, reference yields, so things like government bond yields increased, that has hurt our sector. And the reasons being, the impact of higher rates, that provides a headwind for the present value of these long-dated cash flows that our companies generate. And then secondly, there's the relative attraction of say investment-grade bonds or government gilts or treasuries in the US, for example, which are now yielding higher levels. And of course, infrastructure, including our particular area of focus in renewable energy infrastructure, has sort of derated accordingly in order to offer sort of reacting to those higher reference yields on other traditional fixed income assets. So that's the sort of backdrop we've been in, and we've seen this strong positive reaction late last year as markets started to sort of think about rate cuts coming down the line in 2024. I think markets got a little bit ahead of themselves, and long-dated yields came back quite sharply, and they've blown out a bit more this year as the markets had to sort of temper its expectations around the timing of rate cuts. But going back to the question, you saw that reaction late last year, that very strong positive reaction to the idea of rate cuts coming. We fully expect them to come during 2024 in all our sort of key jurisdictions where we're exposed. And so I think it's reasonable to expect that kind of, bounce back, that sort of good performance to sort of reignite as we get greater visibility around those rate cuts. So, yes.
That certainly makes a lot of sense. I guess looking at the bigger picture here, how do you expect these underlying trusts and assets to behave through an economic cycle?
Yeah, so at the asset level, these are companies that have very highly contracted cash flows, right? They're selling, the companies we own, they are selling electricity. They're selling the power they produce on a highly contracted basis. So, these are underpinned by very long-term contracts with high-quality off-takers, whether those are utilities or other high-quality quality corporates. The electricity that's produced is also a critical service. And so regardless of the stage in the economic cycle, I think, at an asset level, we'd expect the assets to continue generating the power, continue to generate cash flows, and, those very resilient income streams. At a trust level, so a company level, the ratings that are ascribed to these trusts and companies are subject to market sentiment, and that does oscillate through market cycles. I think from where we are at the moment, looking to sort of relatively flat sort of economic growth, certainly at home in the UK, we're in a technical recession. If that leads to rate cuts as we expect and lower longer term yields, I think that would be provide a sort of a tailwind for ratings. But I'd also suggest that if you're in a period of relatively weak economic activity, the relative security and resilience of the cash flows that these companies generate, I think, may come back to the fore, as we've seen in the past, and investors sort of they come back onto the radar for more investors potentially.
And Will, more recently, and very much all over the news at the start of this year, energy storage and battery trusts have had a horrible time. Why is this? And does the fund have exposure to this area? And how have they performed?
So you're right. The pure play battery energy storage companies, these are sort of mainly listed in London, have had a difficult time. So revenues fell in 2023 versus the prior year, and that decline became far more sort of acute towards the back end of last year. So a disappointing year on year for revenues for these companies, and at the same time, the underlying sort of cost of debt, for example, has increased. So they've had a bit of a challenging year, and the reasons for that on the revenue level is lower ancillary service revenues from providing services to the grid. That follows very high prices available in 2022. To a degree, that reflects greater saturation of batteries in the market. A second reason for lower revenues would be sort of the lower intraday volatility we've seen in electricity prices, and this is sort of in part caused by it's partly impacted by the absolute level of power prices coming back. One element, but basically that lower intraday volatility has reduced the opportunities for trading revenues, again on a sort of year-on-year basis. So, certainly providing some headwinds for that space. And you're right, the companies, the share prices have declined, derated, very sharply. We do have some exposure in the VT Gravis Clean Energy Income Fund, relatively modest. But what I would say is where we have that exposure, we recognise the revenue uncertainty in these models, certainly versus the core of our fund, of our strategy, which is highly contracted renewable energy generation. So I think we sort of apportion the exposure to that risk to these companies accordingly, and sort of recognise they sat in our, let's say, more commercial revenue bucket.
And Will, how do valuations look today on battery storage, and I guess more broadly across the portfolio?
So in terms of the ratings of these companies, share prices versus the latest asset valuations, the battery storage names are, trading at very deep discounts. There has certainly been a reaction to the deterioration in revenues recently. It has surprised the market more broadly. So I would suggest that things have derated quite significantly, and we're actually looking at, certainly in recent days and weeks, companies in this space sort of trading below replacement cost for their assets. So I think they are quite depressed. And let's not forget that battery storage, has a key role to play in the future of the electricity grid in the UK and more broadly. We understand why they've derated recently, but I think it's probably overdone, and we have started to see a bit of a move off the lows. You asked more broadly across our universe. I mean, it's fair to say that the broader sector has derated significantly over the last 12 to 18 months. Now, this has been driven by the sort of macro factors that we were talking about a bit earlier. And I would suggest that, when you look at the yields on offer from these companies, where they trade relative to their asset valuations today, we haven't really seen the sector trading at such low levels, certainly not in the fund's lifetime.
And generally speaking, these assets have greater exposure to power prices. And now that prices have started to come down, what's your view as we stand today? Does it influence the opportunity available? And as you just said, it's, valuations are incredibly cheap levels versus their long-term average. Does it make that opportunity set more compelling for the fund going forward?
Well, on the point of power prices, I think it's important to understand, as I noted earlier, a large element of expected revenues are contracted. And these are a mix of subsidies that underpin an element of revenues. You've got fixed power price sales, so long-term power purchase agreements that sort of give you great visibility around pricing, or more shorter-term hedges, which kind of lock in, visibility on revenues, and then you may have some market exposure, wholesale electricity price exposure. I think we need to, as power prices have gone up, in recent years on the back of, largely driven by the conflict in Ukraine, but the energy market was tight going into that anyway. So you've had a spike in prices, and they're starting to alleviate considerably now. Just like companies didn't benefit on a one-for-one basis as prices went higher, because of their hedging, forward sales, for example, they're not coming back on a one-for-one basis either as these power prices fall. I think the other thing you've got to note on power prices is that a lot of the action that we're seeing, the volatility in prices, is at the nearer end, right? So on a sort of, let's say, 1 to 3 year view is where prices have spiked up and are now coming lower. The very long-term sort of power price curve that a lot of these companies incorporate into their valuations has actually been relatively stable. So it's really sort of near years where you've seen this big volatility in power prices. But as I say, it's not for, asset valuations or cash flows don't move, one for one with those near-term movements. Some companies have benefited significantly from recent higher prices, and it's improved their profitability. Those are the companies that have had greater exposure to spot prices. So to your question about, how maybe does power pricing influence the opportunities available? I think for me, maybe it's, it may influence views on exposures. So a good example would be, well, let's just say having a bigger exposure to companies that maybe have more spot exposure in recent years has been beneficial. As power prices are coming down lower, perhaps you might have a more constructive view on companies that have sort of hedged into that higher environment and are therefore perhaps less exposed as these prices have come down.
And Will, the aim of this fund is also to deliver a regular income for investors. How do the underlying companies generate this reliable income?
Yeah, so in the main, the companies we own are producing power, renewable energy, and these are sold to off-takers like utilities and other corporate entities, for example, on very long-term contracts. As I've mentioned, a lot of these companies will also benefit from receiving subsidy payments for the power they produce, further supporting those revenue streams. Now, companies return a large element of those cash flows to investors, such as ourselves, via dividends, and that's really what we're focused on. So it's those, these companies are providing a critical service, right? You need this electricity throughout market cycles. They sell it to various users or off-takers on long-term contracts. That cycles back to very visible and reliable cash flow streams that they distribute to shareholders such as ourselves via dividends. And that's how that income stream comes through and it is quite dependable.
And finally, how does this fund fit within a wider portfolio for investors?
Yes, I'm probably the wrong side of the fence, perhaps, to comment. But from my point of view, in a multi-asset portfolio, I think the strategy can certainly provide a diversifier, alongside other traditional asset classes that you would have in there. And I guess, probably needless to say, it certainly would be useful, I believe, and naturally fitting in an income-focused multi-asset portfolio, that's for sure.
Will, thank you very much for your time today.
The VT Gravis Clean Energy Income Fund taps into the expertise of the Gravis Group to create a portfolio of renewable energy and energy efficiency-related projects that are benefiting from the secular move to a more sustainable energy demands. For more information on the VT Gravis Clean Energy Income Fund, visit FundCalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.